Thanks for joining David, Kevin, and myself for the educational video for the month of August. David and I and Kevin get quite a few questions on what's better, paying down your debt on a loan or investing the money. And unfortunately, there's not one clear answer. There's a lot of variables that go in. So David and I are going to show you a couple of examples of which would be better in each one of those situations.
Yeah, in today's video, we're going to suppose you have $100,000 that maybe you've inherited, and what should you do with it? Should you pay down your mortgage, or should you invest it in the markets? And obviously, it depends on the interest rate cycle we're in. It depends on what investment you're contemplating to purchase, and also what type of account you're going to put that money into, whether it's a tax-free account or a taxable account. So there's all sorts of variables, like Harry said, that one must factor in. And ultimately, you should be chatting with us, your financial advisors, if you're unsure of what you should do. But in today's video, we'll try and walk you through an example of why we think, generally speaking, you should probably look to invest that money rather than paying down a mortgage.
Yeah, and all debt isn't created equal. Obviously, we've got credit card debt, pay loan debts that have extremely high interest rate. And these are no-brainers. Obviously, we have to focus on paying those debts down first. Where it gets a little trickier and where the examples will sort of help you out a little bit is like a mortgage rate, these 5.5% interest rates. These have a lot of different variables. And again, it depends on what you're doing with your money. If you've got money sitting around in a checking account making nothing, well, obviously paying down the mortgage interest rate is better because you're saving 5.5%. But there are different options, and David's going to walk you through some of them.
Yeah, I think also the interest rate cycle, as we saw a few years ago, Harry, in late 2022 into 2023, a lot of people had variable rate mortgages that had skyrocketed over the course of about 18 months. They went from, 2% rates in COVID up to upwards of 7 or 8%. And so when you get to that, usually around 6 or 7%, that's where we start to say, okay, well, maybe just paying down the debt is a better option because understanding what the alternative option, what you're going to earn from an alternative investment is really the crux of what you need to be looking at. How much is the investment that you're going to invest in earn over the long run compared to that interest rate debt? So where we are in the interest rate cycle matters, and also what type of debt we're talking about. So we're going to look at an example now. In this scenario, we have a mortgage of $500,000 with a 5% fixed interest rate and a 25-year amortization period. Alternatively, you have a TFSA account invested in the TSX that will earn 8.5% per year. In this case, would you be better off investing the $100,000 or using the $100,000 to pay down your mortgage? So let's look at how this performs over the next 5, 10, 15, and 20 years. If you look at the graph on your screen, you can see, represented by the blue line, the total interest savings on the mortgage, and by the red line, the investment growth in the TFSA. Putting $100K on the mortgage immediately reduces the principal, so less interest accrues every month. Those savings accumulate over time and the amortization shortens, but the curve tapers as the balance of the mortgage falls. Investing $100,000 in a TFSA compounds. Over time, the growth accelerates the longer you leave it invested. The bottom line for this example is that over 5 to 20 years, the investment growth of the TFSA meaningfully outpaces the mortgage interest savings under these assumptions. Now, the mortgage prepayment is a guaranteed 5% benefit, whereas the investment is not guaranteed and can be volatile, but the expected payoff should be much higher over long time horizons. As with most things when it comes to finances, we don't always advocate for an all or nothing approach. You don't have to just pay down the debt. You don't have to just invest the money. Although in this example, if you're willing to invest in a broad universe of diversified stocks like the TSX, which has compounded at 8.5% per year historically, ultimately, if you're willing to put up with volatility and you can get through the bad years to enjoy those good years and ultimately get that 8.5% average return, you can see that in the long run, that will pay off as long as your interest rate on your debt is below 8.5%. But the higher that interest rate is, the more appealing it may be to pay it down. Certainly, like we said before, credit cards at 22%, that is a no-brainer. No investment in the world is guaranteed to make 20% per year. In fact, some have, but you have to take on tremendous risk investing in individual stocks, more narrow subset of risk in order to try and get 15 or 20%. And so generally speaking, we'd say if you have higher interest rate debt, go ahead and pay that off. But if you have a lower rate mortgage, oftentimes investing it in a tax advantaged account like a TFSA or an RSP can make more sense for you in the long run. But again, it comes with that behavioral challenge of having to go through tough markets inevitably over, any 5, 10, 15, 20-year window is going to have COVID. It's going to have a financial crisis. It's going to have wars. We're going to have to deal with those things. Whereas for some people, if you don't have that investor stomach to deal with those ups and downs and watch that maybe in that first year, that $100,000 might drop to $90,000. And if you're going to panic and sell it after it's dropped 10%, then maybe just paying down the debt is the better approach for you. But oftentimes a little bit of both can work too, right? If you have $100,000, investing some of it, paying down some of the debt is never a bad approach either to take sort of shoot down the middle. But generally speaking, we would suggest that investing in the markets rather than paying down lower interest mortgage debt is the better route to go.
Great advice, David. And we're here to help you guys navigate any of these questions, but please, if you have any of them, please give us a call. We're happy to help out at any time, and I hope you guys are having an amazing summer. Take care.